Welcome, inquisitive minds and answer enthusiasts, asking the most important whys people of today looking to the future should know. Together, we are outlining for you the greatest knowledge of the most knowledgeable of the 21st century. Today's topic: why are real estate, stocks and gold not profitable investment ideas, and why are these not the smartest investment choices? Billionaire Micheal Saylor, the founder and executive chairman of MicroStrategy, will tell you in this video. Saylor is known for his bullish theses and investments in Bitcoin. He points out that even the best investors in these traditional markets can barely keep up with the real inflation rates. Inflation equals the reduction in purchasing power of money. The following speech was held by him in Prague in June 2022, in which you will see him giving significant historic and economic evidence why investing your money in these traditional assets is not making you richer.
Smart investors, people bragging about making money in the stock market. The S&P index is going up 7 to 8% a year. And so you must be really smart. You invested in companies that are making good decisions. Look at the money supply. The money supply is going up at the same rate as the S&P index. And so what you begin to realize is most investment gains aren't really gains at all. All you're doing is simply tracking the monetary inflation rate if you're lucky. That's fake, right? Every single 10 years or every few years, I'll just redefine the market basket of goods, and I'm going to put drywall and manufactured biscuits and Netflix videos and something cheap. You can be sure I take the expensive stuff and I move it out of the consumer basket, and I take cheap stuff and I put it in the consumer basket. Look at the S&P index, right? You feel like you're a genius if you're getting 7.5% against that. Well, what if I told you the real inflation rate of the US dollar over 100 years is about 7.5 to 8%? That's the inflation. Now you see the average investor is getting 2.9% when they're smart. Commodities are less. The S&P is underperforming the inflation rate. This is a chart as of about a month ago. And what it shows is year to date, 1% of the companies in the S&P index had all the gain. If you look at this chart this week, there are 493 companies in the S&P index that have collectively 0% return, and there are 7 that have 50% return. And another way to say that is 99% of the companies cannot keep up with inflation. You think you're going to pick stocks? You're going to pick the winner? There's a 99% chance you won't. And maybe there's a bigger idea here, which is if you have one of the greatest companies in the world, there's a 99% chance after 100 years of being great, you still can't keep up with inflation. And this is why I say maybe your hard work doesn't matter as much as government policy matters. You're not going to find the winner 99% of the time. You remember I've said before, diversification, it's selling the winner to buy the loser, right? All these really brilliant investors that diversify, if they're smart enough to buy Apple or Amazon, when they diversify, they go from 44% return to 10% return. So that leads us to the question, what is money? Right? Because investment assets aren't working so well. What is money? Well, in theory, money is a way for you to store your economic energy and not have it stolen from you by the government, by a bad investment decision, right? Perfect money is, in fact, the solution to all your problems. But what is good money? Gold has been an aspirational money, but it's defective. And the reason gold is defective is because we keep creating more of it, and you can't custody it. And so if I keep creating 2 or 3% more, then that means that the half-life of your economic energy in gold is 35 years. It means every 35 years, your money is cut in half, or the value of your wealth is cut in half. The only way to make gold perfect is to stop mining it and make it possible to teleport and carry around in your head.
As you can see, the official inflation rates are most likely untrue because of the market baskets are actually being redefined with cheaper goods to calculate more acceptable inflation rates. Thus, had the baskets been kept the same throughout the years, the real inflation rate would be lying somewhere around 8% for the past 20 years. Keeping up with this rate with traditional assets is nearly impossible. So the question is, are there other possibilities for protecting your investments against inflation? If you want to know why one specific asset may be the solution to protecting your investments against inflation, then you should watch the next video here. Your future you will thank you. If you like this content, don't hesitate to subscribe and like. You know the drill. Follow the channel for more things people of today looking to the future should know.